Our bank sent you a notification this week. Not about the interest they're paying you on your savings. Not about the return your money generated while it sat in their account. A notification about a new credit card, a balance transfer offer, a personal loan pre-approval, something they want to sell you, because that is the only direction this relationship has ever moved money. You have been a Chase customer, or a Bank of America customer, or a Wells Fargo customer for somewhere between 5 and 15 years. You have kept your savings there because that's where your checking account is, and moving it felt complicated. And honestly, you never thought hard enough about what complicated was actually costing you. I am going to make you think hard about it today. Because the number on your savings account interest rate is not a neutral, market-determined figure. It is a decision made by people in a boardroom, specifically calibrated to be just high enough that you don't leave, and just low enough that the bank captures the maximum possible profit from the balance you trust them with. My name is Mia. I spent years inside financial services watching this pricing strategy get refined, tested, and deployed on tens of millions of customers who had no idea it was happening. Today, I am showing you exactly what keeping your savings at a big bank is actually costing you, in real dollars, in real years, and exactly what you do instead, the number they're hiding in plain sight. Let's start with what Chase is currently paying you on a standard savings account. 0.01% annually. That is not a typo. 0.01%. On every $1,000 you have in that account, Chase pays you 10 cents a year, 10 cents, on $1,000, held for 365 days. Meanwhile, Chase's current prime lending rate, the rate at which it lends money to its most creditworthy customers, sits at approximately 7.5%. Its average credit card interest rate across its portfolio runs approximately 22%. Chase is borrowing your money at 0.01% and lending it at 7 to 22%. Every dollar in your savings account is working extremely hard, just not for you. For them, every single day, while you receive 10 cents per $1,000 and feel vaguely responsible for having a savings account at all. This is not a secret. It is published on their website in a font size calibrated to be technically visible and functionally invisible. It is legal, it is deliberate, and it has been running on your balance for years. The real cost of staying. Let's put an actual dollar figure on this, because the percentages are designed to feel abstract and the dollars are not. The average American household savings account balance sits at approximately $8,000. At Chase's 0.01% rate, that $8,000 generates exactly 80 cents a year in interest. 80 cents. On $8,000. A high-yield savings account at a federally insured online bank, available right now, requiring no credit check, no minimum balance, no fees, is currently paying between 4.5 and 5.2% on the same balance. At 4.7%, that $8,000 generates $376 a year. The difference is $375.20 annually, produced by the same $8,000. Doing the same job, with identical federal deposit insurance up to $250,000, with zero additional risk of any kind. Over 5 years, that difference, compounding, represents over $2,000. Not $2,000 you invested. Not $2,000 you earned at a second job. $2,000 produced by money you already had, sitting somewhere that actually pays you for it. Chase kept that $2,000. You let them, not because you made a bad decision, because nobody showed you this comparison in a way that forced you to look directly at the number. Look at it now. Why your bank works so hard to keep you here is the mechanism behind the inertia, because the big banks are not passive beneficiaries of your loyalty. They actively engineer it. The checking savings bundle is the primary tool. Your direct deposit goes to checking. Your savings is attached to checking for easy transfer. The entire account relationship is designed around the friction cost of separation. Because the moment your savings lives at a different institution, moving it requires conscious effort, and conscious effort is the enemy of the bank's margin. The mobile app is the second tool. Chase, Bank of America, and Wells Fargo have collectively spent billions of dollars building applications that are genuinely excellent, fast, intuitive, feature-rich, because a superior app experience increases what behavioral economists call switching costs, not financial costs. Psychological ones. The sense that leaving means giving up something valuable. You are not paying for the app. The app is being used to pay for your inertia. The relationship narrative is the third tool. Your bank. We've been with you through everything. The language of loyalty, of partnership, of a relationship that runs both directions. It doesn't run both directions. It runs in one direction, your money toward their balance sheet, at a rate of 0.01% per year. I know. The audacity of the marketing budget spent on this is genuinely impressive. The HYSA reality. Without the hype, high-yield savings accounts became mainstream conversation after 2022, when the Federal Reserve began raising interest rates aggressively. Online banks, which carry dramatically lower overhead than physical branch networks, were able to pass a meaningful portion of those rate increases to depositors. The result was rates between 4 and 5% on fully liquid, fully insured savings accounts. No lockup period, no investment risk, no complexity, just a savings account that pays an actual return. Here is what a high-yield savings account is. Federally insured by the FDIC up to $250,000 per depositor. Identical protection to your Chase account. Fully liquid. You can move money in or out within 1 to 3 business days. No fees at reputable institutions. No minimum balance requirements at most. No credit check required to open. Here is what it is not. It is not an investment. The rate is variable. It moves with the Federal Reserve's benchmark rate, which means it will change over time. It is not a replacement for investment accounts for long-term wealth building. It is a savings vehicle. The correct vehicle for money that needs to be accessible, protected, and not quietly consumed by the gap between 0.01 and 4.7%. The current rate environment will not last indefinitely, but even in a lower rate environment, high-yield accounts at online banks have historically maintained a spread of 3 to 4% above major bank savings rates, because the overhead difference between a digital bank and a branch network on every corner does not disappear when rates change. The move. Exactly how to do it this week. Step 1. Open a high-yield savings account this week. The institutions currently offering the strongest rates include Ally Bank, Marcus by Goldman Sachs, SoFi, and Discover Bank. All are FDIC insured. All have zero minimum balance. All take under 15 minutes to open online. Step 2. Keep 1 to 2 months of expenses in your Chase or primary bank checking account. You need that buffer for daily transactions, bill payments, and the occasional transfer that needs to happen faster than 3 business days. Step 3. Transfer everything above that buffer to the high-yield account. Not someday, this week. Every month you delay is another month of $376 annualized sitting in Chase's revenue line instead of yours. Step 4. Set your paycheck direct deposit to split. A portion to checking for monthly expenses, the automatic savings contribution directly to the high-yield account. Most employers allow direct deposit splits with a routing number and account number. The money that never enters your checking account is money the lifestyle machine never sees, and therefore never spends. That is the entire move. No complexity, no risk, no giving up the Chase app for daily banking. Just relocating the savings portion of your financial life to an address that actually pays you rent. You didn't make a mistake banking at Chase. You made a reasonable decision with the information you had, which was, by design, incomplete, because complete information would have cost them $2,000 of your money over 5 years, and they were not going to volunteer that. You are not behind. You've just been reading a map drawn by the people who want you lost. Hit subscribe. Because next week, I am showing you the retirement account fee structure that is doing to your future self exactly what Chase has been doing to your savings, quietly, legally, and with your full unknowing consent. And I'll leave you with this. Your bank has had your savings for years. It is time to ask, plainly, mathematically, without sentiment, what it has done with them. The answer is in your interest rate, and it should make you angry enough to open a new account today.